Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, March 26, 2021. Going to go over the indexes, maybe hit on a couple other things I've been watching lately and covering, such as crude, natural gas, time permitting, but I'll keep it relatively brief here. This is the SPY daily chart, SPY. So what happened yesterday is early in the day we were under that. We had broken the 387.81 support, but SPY managed to close back above it, turned around and rallied, closed above it. And so I talk about that often. On the daily chart or whatever time frame you're trading, the most important thing is how that candlestick's finalized. In other words, if you're trading on a 60-minute time frame, you want to wait and see what the 60-minute candle does. And on a weekly chart, how you close the week. So on this daily chart, we had an intraday breakdown. That was the onus was on the bears to take it down to that next target, next support at 370.45, but they couldn't do it. So bulls stepped in, or the buyers stepped in, however you want to call it, and closed it comfortably back above there. And so that is near-term bullish. I thought we might get some downside follow-through, but we didn't. So where it leaves us is today, or not today, next week, or anytime soon. Now you need to take out that low. We also defended the 50-day moving average. I think I covered that in one of the recent videos. I had the line turned down. You can see it right here. Make it nice and bright. See, the 50-day often comes in as support, and has been recently right there. Perfect support there. Trying to another intraday big break, and then to rally back close to or right above or closed on it. Let's see, depending on where we closed that day, 376. So we closed right a hair under it, and then got it back the next day. So far, so that's another successful pullback to the 50 right there, and successful defense of the 387-ish level right there, about 388, 387. And so there's no other way to spin that but near-term bullish. And so where we're at for now is we need to take those lows to take out those lows, yesterday's lows, to open the door for another move down. Otherwise, you have to respect the fact that the indexes, quite a few of the indexes, hit support yesterday and did so with bullish divergence on the 60-minute time frame, and that's hence the catalyst for this rally. I'll get to the 60-minute charts in just a second. QQQ, same story. QQQ, the big level I've been highlighting recently is about that 310 level right there. The yellow line, it was the bottom of the trading range here. It was support back here. We hit it once, twice, and then yesterday we went down intra-period. Early in the morning we're down below, only to close right back above or right on it yesterday. And so that's another successful defense. So if you're just doing the play-by-play short-term analysis, you give a check mark to the bulls for successfully defending support, especially with that brief intraday period or intraday break below, only to rally back up and close it there. Now we're still sitting precariously close to support. The Qs are also weak. I wanted to point that out before we move on to the small caps and then the futures. Today just about everything's up. Crude's rallying, and most of the indexes. But if you look under the hood, again, it's a common theme I'm seeing is it's just weakness in the leaders, and usually that's not a good sign for the market. When your leaders stop going up, look, they're really not going down much. I mean, we are in a near-term downtrend on Apple being the biggest of the lot. And since it topped here on the fourth quarter earnings and put in a divergent high, had that little false breakout above the channel, that was bearish. And then we went down, hit this first target support at 125.75, and broke that. And so far we're below that. We're also below that 50-day moving average right there. So there's a lot of resistance overhead. And from a technical posture, we're pinched right now. Between support, you have the 200-day simple and exponential and simple moving averages just below, and you have this trading range here. So again, this is, I just showed you how on QQQ and SPY, the fact they defended those support levels yesterday, you give a check mark at least for that, and then the follow through today to the bulls. But it's still anybody's game here. Again, it's not a good sign. This could just be healthy sector rotation or rotation out of market leading, big name tech stocks into other things. And if so, sooner or later you're going to have to see these leaders come back and take out those highs if you're expecting a big wave up in the market. Otherwise, this is indicative of institutional distribution, institutions, big, hedge funds, pension plans, mutual funds. That's what they're chock full of because of the liquidity and the growth in these companies and the size of these companies. And if the institutions were buying, obviously they're not buying. This could be stealthy distribution from the institutions to the individual investors. Again, I don't want to harp on it too much, but again, I did want to point out these developments. There's Apple, Microsoft. Microsoft is in this trading range recently, not really going down, but it's not going up either. It's been bouncing around that big, what I think to be a big level, about 228 support, with the gap resistance and price resistance about 240 overhead. So again, not going down, but not going up. And we'll see where ultimately these resolve. Same thing when you look at Amazon, and a lot of these market leaders, like I said, have topped. Amazon peaked way back then, back in August, and it's been making lower highs as I boxed in here, but we're not necessarily making lower lows. We have that big support. That's why I have that line colored at about yellow at about 24.43 or so. And then you have just below, you can probably make it out there. There's the 200-day exponential moving average. So here's another one boxed in a pretty tight range. And which way these stocks break will most likely determine the next big trend. So that's that. And of course, Alphabet, same story. I mean, it's just amazing how many times Alphabet has bounced on this 205 level right here. It was a gap, and just almost every day for the past month or so, testing that level. Not going down, but not going up. And the way it works is the more taps of a level, the more obvious that becomes to everybody, people trading Alphabet. You can also see this, the yellow line, the 50-day, which came in here, support, here, support. Brief dip below, but we recovered it. Other than that, it does a pretty good job of defining, the trend above or below it. So that's a confluence of support just below, and it's that simple. I think if it breaks, it'll be a big level, probably a lot of stops under there. Or if we can defend it, like I like to say, support is support until unless broken. We'll need to take out the recent highs, and this is going to determine which way the market goes. Despite yesterday's stick save by the bulls, I'm still leaning this way. Obviously, if the odds, just like look at Vegas odds for any event that you're betting on, the odds are going to change minute by minute, or based on any change in the facts. So yeah, the fact that the bulls held that level yesterday decreases the odds somewhat that we're going to go down here. So I'm not as confident as I was yesterday. Let's say if it was 80% chance that we're going to break down. Now we're down to 60, whatever the number is. It's just a little bit less. But also keep in mind the market's not going anywhere, or at least not a big correction, not that other 8 to 10% plus that I said is potentially priced into the charts. It's not going there without Alphabet and Apple and these stocks breaking down. They're above big support, and because of their weighting, most importantly, it's the mathematical weighting. They're overweighting in the indexes, just saying the S&P is not going to drop much without these guys going down. And then there's the psychological importance as well. So that's it. And Facebook, all the same story with these market leaders. They've just stalled out now for months, going back to last year, last August or so. And boom, 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 boom. Now, Facebook happens to be closer to resistance, closer to breaking out than it is to breaking down, unlike some others, but it's one to watch. And, when you zoom in, what happened recently, it was another ramp up into that resistance, the top of the trading zone, and a rejection so far. So there it is, big levels, and I don't see how anybody could be adamant that we're going to go, the next big trend will be this or this, until you start to see the majority of these stocks, these market leaders, break either above those recent trading ranges or down below. Being that the MO has been run to the top of the range, come back down, I don't see why, I would expect anything otherwise right now. Although I'll say, you're not going to be in this range forever. Each and every time we hit the top or bottom, the odds are increasing or going up that we're ultimately going to break through, that will be a breakthrough, the next run up to the top or the next run down to the bottom, only because these trading ranges don't last forever. And what they do is they serve to act like a coiled spring, with that stock building energy when you're in a consolidation range like that. And part of it, if you want to look at it, why does it work that way? Well, think of it this way. if you're short and bearish Facebook, where would you have your stops? I think you'd have your stops a little bit above this range, and not everyone's going to have them the same level. They're going to be layered like this. And likewise, if you're bull, you'd have them here, your stops below. So what happens if you break out, all those stops get hit on shorts, meaning they're buying, they're closing their position. Longs are going to pile in, and likewise, if you break to the downside, same thing. All the stops on the longs will get hit, shorts will get emboldened, they'll see the breakdown and they'll pile in, and that's why you usually get a pretty explosive move. And the more obvious the range is to everybody, you can clearly see it, then the more participants are going to have those stops in those positions. So that's the way I view it, and that's how it usually pans out. There's Alphabet, again, the other share class, big level right there, and still above the primary uptrend line. So that's the thing. Some of these leaders have broken down below their primary trend lines, and others haven't. It's kind of a mixed bag right now with the big leaders. And there's Tesla. Starting to see, and we'll see if it continues, to see all the moving averages turn down. The 50s starting to turn down. The 200s are flattening out. They haven't yet turned down. That's one way to look at trend indicators, which the direction of the moving averages. Here you got the 50 turned down right here, and you had a good bit left in the correction, whereas the 200 stayed, the slope never went negative. Negative slope on a line is when it curves down. So we flattened out here to almost a zero slope, but it kept the uptrend intact on the 200s. And so that's one thing you want to look at there, especially in a trending market. Don't pay moving averages attention when you're in a sloppy sideways range like this. They're useless. You want to see uptrends like this or strong downtrends to try to extract any useful information there. Okie dokie, so that's what the daily charts look like, and to recap what I put out just before the close yesterday, this is nothing but near-term bullish on the indexes. This is the S&P 500. We put in this divergent low right at that 38.47-ish, 38.48-ish support right there, reversed, and where we were yesterday, right at the close, we had a confluence of resistance right here, about 39.02 price resistance. Back test of the uptrend line and the downtrend line, all three were taken out. So I can't spin that as anything but near-term bullish. Yeah, so unless that fails, that is a near-term bullish technical event, which would indicate more upside. Again, unless we get some selling and then that proves to be a whipsaw. And if it is, you need to react. If you're long, if you took these things off support or after the divergent low was in or today on the breakout, wherever it is, you'll want to respect a move back down through there. That's, I think, an ideal place for stops, just below that confluence of support, which was broken, and now that's a confluence of resistance. And then keep in mind too, when you go back here, zoom back, let's go back 3 months. This is the simple watch, rinse, repeat stuff. Look for these divergent highs. They usually precede corrections. Look for the divergent lows. And now here's the thing. This is what I want to say. The MO for quite a while now has been you get these little corrections within a larger uptrend since the lows back in March of last year. And these divergent lows have always been, this is the technical catalyst for the rally to the next leg up to new highs. So each and every time we put a divergent low in the 60-minute charts, there's been an explosive rally, took the S&P 500 to new highs. That usually ends with negative divergence, and you get another correction, and wash, rinse, repeat. You put a divergent low back here, boom, blast up to new highs, marginal new highs. And that's also the pattern. They're always marginal new highs. Typically, and that's what it's been, followed by, again, you look for the divergence and you get a correction. So now where I'm going with this is our first divergent low, and confirmed as well. All the indicators turned up. It's confirmed positive divergence since back here before that last leg up to new highs. So if we don't go to new highs at this point in time, if somewhere in here anytime soon, and if it's going to happen, I suspect it's going to happen really soon, as in next week. Probably not today, but it would most likely happen next week. If the sellers step in and they foil this breakout and they take this, they run the market down, they take out yesterday's lows, again about 38.47.80, and take it down, then it's going to show me a change of character. And the reason I'm still open to that possibility instead of just load the boat for the next leg up is because of everything covered on the weekly charts and the daily charts, the divergences. everything, those extremes in sentiment that have been building and building. Divergences in the percentage of stocks above their 50-day moving average. That's a breadth indicator I showed recently. Bull bear ratios, all that kind of good stuff. And so that says be on the lookout that it may not be so simple this time around, and this may not be, this divergent low might not be the catalyst to the next high. But as of now, you have to respect it, and everything I've seen since yesterday, especially this morning when we broke out and back tested, again, you zoom in, that is nothing but bearish near term, or bullish, I'm sorry. Nothing but bullish, the breakout and back test of the downtrend line right here. So that would indicate more upside from here unless this gets sold into. So that is the S&P 500 futures. NASDAQ, again, sucking wind, but again, simple stuff. You go back for months, positive divergence, boom, rally to new highs. Divergent high, correction. And that was a pretty healthy correction, 13 or so percent in the NQs. Divergent low, rally up to divergent high, your sell signal with the breakdown back test, divergent low. So this pattern would indicate, okay, now off to the races to new highs, the next marginal new high. But so far, this has been very muted buying off that divergent low. It's not as impulsive. The Russell 2000 had a pretty sharp rise yesterday and so far today, but not so much in the NASDAQ. So again, this is our leading index. This is the tech-heavy, 50% plus technology in the NASDAQ 100. Tech's the biggest sector in the S&P 500. And, maybe again, if you want to play glass half full, being you're an optimist and bull, you can say, okay, healthy sector rotation. Tech's led the way for a long time. Now we're seeing other things pick up the baton. Great. And that may be the case, but the longer that tech lags behind, the more of a red flag it is. So we'll keep an eye on those market leaders I started out with, and keep an eye on this index, which is, again, very tech heavy. So what do we need to see? Just like everything else, and I think it'll be a very swift drop. I keep talking about, and we have had. I said it back here, and we did. We finally had a very impulsive selling there, and we've seen volatility spike. But if we break yesterday's lows, again, it's going to probably clear out, hit a lot of stops on longs, and probably open the door for the next swift move down and hit those lower price targets that I've been talking about on QQQ and IWM. And then last but not least, let's talk about the small caps. Same story. These divergent lows have been the technical catalyst for these big runs up. Divergent highs, like this was a divergent high there, drop, divergent low, rally. And that was our last sell signal and a nice divergent high, breakdown, and we've been stair-stepping lower. This rally's been strong, but what has it done so far? Well, it did take out this trend line, so you're going to have to give it respect that. Yesterday when we closed, we were right there. In the overnight session, we went through there, and we also took out that 2204. So again, right now, as of now, and this could change, that's nothing but near-term bullish. Should we reverse? And I still, open to that possibility. The odds went down a little bit since yesterday when we got, when we took out that resistance and then the 2204 level. Although, actually, as I do the video, we're at 2206. So for all intents and purposes, we're on resistance now. And that's what's been checking IWM all day. It's had a couple runs at that, and the selling has stepped in. So, and then if you look at it from a trend perspective, and this isn't a be-all, end-all, but it gives you an idea. A downtrend's defined as a security making a series of lower highs and lower lows. And so far, that's the case. Here's your lower lows. And that was our last major reaction high right there, and we're still a little bit below it. Does it mean if we take that out, then boom, it's off to the races? No, but it certainly increases the odds that the correction is over. And that's how it works. And you take out these reaction highs, and it further increases the odds. So that's where we're at right now. And so at the end of the day, right now my convictions aren't strong, and it's Friday, so we're going to have whatever you take home long or short, you have 2 extra days of overnight risk. So keep that in mind. All right, quick updates on the other stuff. Crude oil, that would be CL, if I can find that. I'm just using the futures now because that's what I've been focused on lately. We hit that third target at 57.25 right there. The other day, we did it with positive divergence. We had a kick up, rally back up to my first target, which was 61.03. That was former support. Support once broken becomes resistance. We got checked. We went down, tested T3 again, and what that did is it extended the divergence. So we had positive divergence before, and we still have it. It's even just a little bit larger, and we're right back up to that 6103, which served as resistance. Undoubtedly, or unarguably, that the big cargo ship, you probably read about it in the last couple of days, it's blocking the Suez Canal. Some ginormous ship that got grounded out and it's blocking, so they're having to divert ship traffic. Hundreds of ships were backed up, and a lot of the good part of the world's oil goes through the Suez. So that's given a fundamental boost. But again, technicals are the overriding factor. And now what I suspect will happen is, and we might not know until over the weekend. I don't know. I haven't seen any updates. Maybe they got the ship out today. Last I heard, it was still stuck. But if they get it out and ship starts down, maybe you'll see a quick drop down. It's just like the stock market. You just have to take out yesterday's lows to open the door to this target. I'm still leaning towards a move down here to 54 in crude. I'm not sold on it because, again, it's hard to get bearish when you just put in the first divergent low on the 60-minute chart in some period of time. But my kind of overriding theme here is crude and the stock market tend to move together. This is no coincidence. This happened and the NASDAQ had its biggest correction in months at the same time. And SPY, has been dropping as well. The outlook for the economy, if you're bullish and you think the economy is going to grow and be strong, then you have to be bullish on oil, or at least demand for oil, and vice versa. So these kind of go hand in hand. If you're long crude, it's a very correlated trade to being long equities, and vice versa if you're short. So where I'm going with that is, if these divergent lows in the stock market and crude oil fail to play out for anything more than this is just a relatively small, so far this is nothing more than a counter trend bounce. This is a trend, their near-term trend down. This is a counter trend bounce. We take out that high, yeah, that's going to change things a little bit. We take out 63.76, oh, that's certainly going to change things. But so this is where we're at, and this is what I'll be looking for, and I'm leaning this way right now. And again, it's not confirmation bias, seeing what I want to see. Believe me, I love these 60-minute divergent lows. They're great to go long, and I've had some long trades off there yesterday, but I don't think it's going to be the catalyst to the next leg up. I just put the odds at below 50% on that. And again, it has to do with the long-term charts and everything that's gone on there, and some of those other developments I covered. So that's that. Let's do an update on natural gas. Natural gas hanging in there. So the story on natural gas, if you didn't see the last few updates, we had a downtrend line here on the 60-minute time frame. We put in positive divergence here, particularly on the PPO, near divergence on the RSI, but not exactly. So we had PPO divergence. That was the catalyst for this reversal. Went up, hit this 616 resistance level, and at this point we hit it here. After taking out the downtrend line, we hit it again and again and again and again. We've been trading on it. So at this point, I still like this one. It's not an all-in type trade. I've seen better setups in NG, absolutely. It's in a near-term downtrend. I'd prefer to see divergence on both indicators. But this is the story of NG right now, or natural gas. And you can trade UNG if you want to use an ETN for it. And there's some others out there, I believe. The story is we need to take out here's where we're at. We're at we'll call it 262, round it up. We need to take that out with conviction. If we do, opens the door to my next target at 274-ish, and if and when that goes, that's my current at this time, and that may change, but right now my max swing target up to about 293. And same story. If we go back down, get rejected here off the top of that trading range, you have pretty big support here at 252-ish, and if that goes, then that's where you might want to let it go, have a stop under there. So again, objective entry on a solid break above 262. objective. I don't know if I'd short it. No, I wouldn't short it. Sometimes, everything's not binary for me. Just because something breaks down, the bullish case can no longer be made doesn't mean I'll automatically flip and go short. Because if it breaks down, you're going to still have positive divergence just below. And that's similar to, wheat. I showed you the other day. Wheat went a little too far, but I said if it did, when it failed right here, we had that little, we had divergence right here. The other day I highlighted wheat as a trading op. It regained this. That was near-term bullish. Popped back above that big 627, 645 support. Resistance at that time. Ran right in the downtrend line, a little shy of that first target, and then moved down. But what I said at the time, look, I said if it goes down, guess what? It's only going to extend these divergences, just like what's going on in the stock market. Stock market's had these little pullbacks along the way. All the while, the divergence gets bigger and bigger on the daily and weekly time frames. And so that's what happened in wheat. So wheat still has a chance to rally. If you took this one, you're giving it room, you could certainly see it. Again, I don't like the fact that it recovered this level here and then couldn't hold that. So if, at first it looked like this was a whipsaw, but now this was a whipsaw. And I get away from security. Too many whipsaws. I'll sit and watch and re-engage wheat, when the time is right. And, again, a case can be made to even step in here, but it's not a strong enough case, in my opinion. Just because we have divergence is not a reason to buy. The problem with divergence is it can grow bigger and bigger as the security continues its trend. And sometimes the divergence gets taken out. So after having positive divergence for a while, the indicators move down below their previous lows and you no longer have it. So I like to see, a catalyst of some type of buy signal. And right now, again, if I had to flip a coin and go long or short, I'd go long right now. I think it'd probably go up from here, but that's the thing. You don't have to do coin toss odds in the market, nor should you. Try to take trades that put the odds in your favor. And that's it. Let's wrap it up there. These are the things to watch for. Again, I don't think we're going to have much resolution today, with it being, now it's 1 o'clock on the button on Friday. SPY is a little bit above that 382, 388 support, but not by a lot. QQQ, same story, just on top of that 310-ish support. And that's it. So we'll see if next week do we hold above these lows, build on these gains. If we do, the next objective long entry, or even, well, the next objective short entry would be another push to the top of there. That's resistance 324.65. So you could short there with a stop above, or close longs that you have right now if you're trying to swing to the top of the channel, or wait for a breakout above there and then go long also. So there's a lot of ways to trade these levels. And there's other factors too. We'll see what's going on with the 60-minute charts at the time, what's going on with the leading stocks and the NASDAQ 100. We'll see what's going on with the other sectors and everything else. Okay, we're going to wrap it up here. I'll get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great weekend.